Hello guys, you're welcome to my videos. Welcome to Sami Forex. If today is your first time watching my videos, please don't forget to subscribe. Okay, hit that bell button so you get notified anytime I upload another video. You won't want to miss. I'm teaching this. Doing these teachings from the scratch. You see how many topics I have here. We've talked on so many things already. Okay, so if you find it deemed fit, you can join our trading group on WhatsApp. The link is on the description below. You can see we've talked on traditional recharge, we've talked on price action. Today, if time permits, we'll talk on stock concept of supply and demand. But before that, I would love to uh, there are some frequently asked questions in my group that I really want to tackle right now. Okay, what is a broker, price action, what is a trend line, trading sessions, swing highs and lows, oscillators and indicators. Okay, these are the frequently asked questions. Then we will move to WhatsApp. I dropped some basic forex terminologies here that as a newbie you might come across. So when you hear someone as a forex trader mentioning a name of something or mentioning a name that is strange to you, you don't get stranded or confused. You all follow up immediately. So, but I just wrote them down and I did not break it down. And some people are already complaining they don't understand. So, I will explain it, break it down as much as I can. Remember, I love simplifying things to even a 12 years old baby. Okay. So quickly, let me start from here. Whenever you hear someone calling a currency pair, let me start here and see where I'm beginning from now. Okay, so please follow up right now. Whenever you hear someone calling or mentioning currency pair, you should understand that in forex market, the forex market is traded in currency pairs. What do I mean? We don't buy and sell clothes here. We don't buy and sell food stock condiments here. We don't buy and sell houses here. Okay, what we do in forex is we buy and sell currency pairs. We buy money, we use money to buy money, and we sell it to still get money. That is the best way I can define this currency pair. We are using money to buy money. Use our currency pair to buy another currency pair. You can, as a forex trader, you have access to all the currency pairs in the world. Do you understand me? As a forex trader, you have access to New Zealand dollar. You want to own a New Zealand dollar today, you have access to it. As a forex trader, you want to own a pounds today, you have access to it. As a forex trader, if you want to earn in Australian dollar today, you have access to it. Any currency pair at all. Okay, so exchange rate, whenever you hear someone mentioning exchange rate, usually is and even in a layman understanding, what is an exchange rate? When you ask what's the exchange rate of naira to dollar, you already have the answer to it. When you ask what's the exchange rate of pounds to dollar, you already have access to it. That's exactly what I mean. The rate at which one country's currency can be exchanged for another is called exchange rate. Okay, now you have the base currency. What is a base currency? When you open your forex chart, for example, and okay, let's go there quickly. Let's go there. Let's go there. Okay, now we are here. Now we are here. We have this. This is a market watch where you monitor the price movement of or the bid and ask price of any currency pair. Okay. Now the meaning of this euro USD you're seeing, for example, it means or let me use this one. So it will be a little bit complex so you understand. If I can break this down, then you understand this. Now, AUD card, for example, why are you seeing this? It means these are two countries, two different countries coming together to form this, to make a deal that, okay, let's make ourselves available and let people trade between us. Okay, now AUD card means this is Australian dollar. This is Australia, but this one is the Australian dollar and this one is the Canadian dollar. They all made of dollar. Okay, just like America, they also make you have the US dollar. Canada makes of dollar, Australia makes of dollar, okay, and there are some other country that makes of dollar too, but they must indicate, all right, that okay, this country is the owner of this particular dollar you are trading. So now we have this one AUD card. It means Australia came together with Canada to make this currency pair. At this point, Should I say Australia are the ones that went and met Canada at this point? Okay, they went and met Canada and said, okay, let's make a deal so people can trade between us. That's why you're seeing Australia as the base currency. Now, the base currency are the first countries that went and met the other country to plot a deal. Do you understand me? Very the base currency, they are the first currency pair on any market you see. There are always two pairs. We have the base and the code. Now the base currency is the first one. The people that went and met the other people to strike a deal together. They are the base. I came to you, bro, how far? Let's do something. Let's make a business. I am automatically I am the originator of that business because I'm the one that came to you and said, brought the business idea, isn't it? Yeah. So the same thing applicable here. So Euro, USD, GBP, USD, GB card, US, and all that, Australian dollar, they are the base, the first currency pair. The first currency is the base currency. Between these two, Euro, USD, what is the base? The first one, Euro. Between GBP USD, what is the base? GBP, that's a pound. Between GBP card, what is the base? GBP. Between AUD card, what is the base? AUD. And what are the codes? The other ones, the last ones, okay? So that is what I mean by quote base currency. Now, I wrote it here. A base currency, that the currency that comes first in the currency pair. Example, GBP USD. The GBP is the base currency. Look at it. Don't get lost. Okay. Now we have the quote currency on the other hand. As I already explained it, the second currency quoted in a currency pair. Example, GBP USD. The quote currency is US dollar. And now when you hear someone saying long, means I want to buy the market. If I tell you tomorrow, hey, it's time, go long on this market, and means I want to buy that very market. And if I tell you to go short, means I want you to sell that market. Bid price. Okay, the market price for sale of an asset, and the ask price, the market price for purchasing an asset. Okay, now I am selling uh a particular cloth, for example. I am the seller, you are the buyer. Forex, your broker is the seller. You as a retail trader, you are the buyer. Now they are willing to sell you for a particular amount. Maybe they are willing to sell you Euro USD for a particular amount, maybe 1.05222. Okay. Now they will give you the opportunity to beat that price. Okay. They might want you to say, okay, price for this market, how much is your last? In the normal language, I tell you my shirt is 5,000 naira, and you say, bro, how far? Can't you sell it for 3,000 for me? That is exactly what they bid, your bidding price. And I am telling you, this is the amount I want. That is exactly what this means. Okay, the bid price, the market price for the sale of an asset, what they want to sell you that asset. But the ask price, the market price for purchasing an asset, the price you finally agreed with the broker to buy. Okay, so spread, the difference between the bid and ask price. Whenever you go into a chart, for example, okay, whenever see here, have you seen this red line, and have you seen this gray line? Okay, this small distance now, this small space between this red and the gray line is what the broker charges you. Normally, any market you enter, whatever trade you strike, whatever deal you strike in any currency pair, you will always start with minus, a negative. Okay, so that distance, that small space, that small minus is what you're seeing. That's what the broker charges you for giving you the opportunity to trade this particular asset. All right, let's continue. Appreciation means an increase in the value of an asset. When the price is gaining value, is appreciating. All right, now we have depreciation like devaluation. Unlike the appreciation where we have the increase, you're buying a market, for example, a market that's supposed to buy at the end of the day is selling, is depreciating in value. Now we have the gapping. Okay, an opening price significantly above or below the previous day close with no trading activity in the in between. All right. Now let me go and show you quickly. Like I said, I told you earlier, this video is going to be very long. Okay, thank God I have one here. Have you seen? This is what we call gap. This is what we call gap in the market. Have you seen that there's no trading activity here? There's no market here. There's no candlesticks here. Okay, there's no candlesticks here. But at the end of the day, what happened? The market had to continue. That means something. There's actually something that went on here that the whole world did not know about. Okay, within the week, it basically happens at the beginning of every week. Let me show you. Let me see when this happened. Let me period separators. Okay, yeah, have you seen this gray lines you're seeing? This period separator you're seeing. This is a whole day. This gray line, the space between here and here is 24 hours. 24 hours. This is 1 hour candlesticks. 24 hours. If you are counting these candles inside here, they are 24, making up a whole day. Now, have you seen that this is the beginning of a day? If I should use this closet to and I should check here, have you seen? I'm trying to make sure I explain this very, very well for you. This is 00 hour, 12 o'clock, breaking the next day. Okay, and you see that the market had to gap. That means something actually happened after the market closed with this candle for that day. Something actually happened between here and here that we do not know about. Okay, probably the market must have traded down, but something happened that we do not know about. And when the market opened, market has to go straight and continue from where the unseen activity ended. This is it. Okay, whenever I see something like that, means there's something happened in the market that we do not know. So normally after that occurs, the price will gap to the to continue from where that unseen activity took place and stopped. So this is gap in the market. That is gap in the market. All right. And open. How do you calculate this speed? How do you determine this speed? Like I said here, guys, a pip is the fourth and final decimal number. Final number after a decimal point. Now, fourth and final after a decimal point. Now, look at it here. Now, for example, let's use this. Uh, let's use this for example. This particular asset, this particular price is 1.05545. Okay. Now, after a decimal number, which is point 0, which is this number, this is the number, the decimal number. We are not counting this already. Those that did mathematics, we are not counting this number. Have you seen it? These two numbers are what you use to determine the pip. Now, if you're calculating it, for example, we have to minus this from the entry price, from the take profit price, or from the entry price to the stop loss price is what will give you the. Let's go back quickly. If I continue this way, guys, this video will take too long. So probably I will come back on the next video to continue from here. But let me go down and take the most important one. Let's talk about a stop loss. A stop loss order is a risk management tool allowing a position to be closed automatically once it reaches a specific preset price. This can protect against further losses on an open position. Okay, let me explain this. A stop loss is a kind of instruction given to your broker, the people giving you access to trade with your small money. Now that is is a kind of instruction given to them that, okay, out of the $100 in my account, probably you know that if you're trying to buy and the market is selling, you're losing. Hope you know. Now, the more the market continues selling, the more you continue losing money. You will lose money as much as the market continues selling. Okay, now you probably at the end of the day you have just $100 and the market continues falling depending on the lot size you use. The market continues falling until it will get to a point your $100 will finish, because the more the market falls, the more your money will continue reducing. Let's go to the chart. Let me show you. Now let's say I entered my market at this point to buy. Go. I entered a buy order here. I want to buy here. Now remember that after I bought it, see what happened. The price kept falling. It kept falling, and I have just $100 in my account. If I don't have that stop loss order, this price continues falling. My money will get finished. How you use to protect your money is this stop loss I'm talking about. It kind of odd is an order instruction given to your broker that okay, if the market doesn't sell, doesn't buy from this point and it drops up to this point, then I am wrong. Whatever amount that is here, take it out. Now, this amount is an amount you already defined for yourself that okay, you've already calculated everything and know that before a market will get to this point, that means out of the $100, I'm going to lose $10 if market doesn't go my way and it falls to this point. Okay, but until it touches this point, you shouldn't close your trade because you've already agreed within yourself, okay, I'm willing to risk this particular amount. That's why you must risk what you can afford to lose, because sometimes you tend to close, maybe the price is at this point, for example, and you have your stop loss here, you tend to close them here with the fear that is coming close to your stop loss, and at the end of the day you reverse immediately from that point. You won't be happy with yourself. So to avoid this whole closing trade before time and all that, make sure you assign a particular amount that you're willing to lose. So that even though you see the market going, threatening to touch your stop loss, already you're comfortable with the amount you're seeing, the negative you're seeing. Okay. If it touches you, fine. If it doesn't touch you, it goes back. Because oftentimes the market will threaten to touch, but at the end of the day, it will not touch. But sometimes it touch, most times it touch. Okay, but you've already defined the loss and accepted it that okay, I want to lose a particular amount of money out of the money I have in the market. So that order, now this act order is something that at the end of the day, whether you're there or not, once price gets to that place, it will stop you out there. Have you ever noticed a situation whereby you marked the market goes to your stop loss, stops you out and continues falling? That is the help of a stop loss. It stops you out and continued falling, fall to the point where you were even surprised. That is what at the end of the day, the stop loss at that point helped you. Because if you had no stop loss at that point and you went out and came back and saw that market fall to that point, okay, probably most of your money would have gone, and the amount that would have gone out of your account is something that you might not I could accept. All right. So this stop loss order helps you to instruct the broker that in case I am away or I'm present, please, when the market fall to this point, I don't want to lose beyond this money. Take me out of the market automatically. That's what it means here. Now take profit at the end of the day. The reverse is the case. Here you have to do with profit. It has to do with profit. If I am around or I believe the market will trade to a particular point and then reverse from there, when it gets to this point and I am not there, or anything happens to me, or anything happens to my phone, or anything happens to my emotions, please take me out automatically. That's the order you're giving to them. A take profit order is a risk management to allowing the position to be closed automatically once it reaches a particular price preset profit goal. This can protect against profit being lost in an unanticipated reversal or price direction before the investor can close the position. Like I said, you already anticipate that price might go to a particular level before falling. That's your belief, because no price will rise forever and no price will fall forever. Okay, prices of the asset go up and down, they fluctuate. So you believe already that okay, from analysis, if I'm buying at this point, market should trade up to this point before anything happens. So that point that you believe market should trade up to is the point you should place your take profit order. So at the end of the day, if you're even though you're not there and price goes to that level, it will close you out automatically. Okay, and it should be a level or a profit target that you are comfortable of. Okay, so that is it. If basically these two guys work, these are the major things, because stop loss is the money, your personal money. This is your personal money. Take profit is not your money. Take profit is the money you're blessed with for making the right decision. So if you are to protect anyone with all manner of seriousness, it should be this stop loss. Because this is your money. This is the money you deposited on your broker to do business with. So protect this one by all means. You can play with this guy, but you see this guy, protect it by all means because this is your money. Okay? If you play with this guy, this stop loss, you might not have your account might not be alive to play the next day. So protect it by all means. You can play around this guy, fine. But this guy, protect it by all means. Okay, so quickly let me go back to my notepad and then quickly answer this question so I will round up this video. What is a broker? Like I said, this a broker is a financial institution that gives you access to trade the big forex market. This forex market is designed for big banks alone. But now these people with their large money, let me call it large money, they had to go. It kind of like someone going to a wholesale shop to buy bulk goods. Buying in bulk, they will give you some discount. Okay. Now coming back now to come and sell it for retailers, people who are coming to buy and go and consume. You and I, we are the retailer, because at the end of the day, when you trade in foreign market and you withdraw your money, what do you do with it? You consume it with yourself and your family. Okay. So we are the retailers, we are the final consumer in the foreign market. These guys have gone to get in bulk to come and distribute to us. So at the end of the day, so that with our $5, with our $10, with our $15, we can trade the forex market effectively. Okay, but without them, you can't trade the forex market with $5, $10. Obviously, you can't, because you can't. The big banks, the city banks, the Bank of America, all of them, they are the ones supposed to be in this market alone. But you and I, with our 5,000, 10,000, $5, $10, we are not entering the market. It's with the help of this broker. They have gone to buy in bulk as the wholesaler from the wholesalers, which are the foreign market, to come and sell for us as the retailers. They are the middlemen. Okay. Now the price patterns, when we call price pattern, these are different like should I say drawings, different pictures, different images. These candlesticks you're seeing tend to form as price tends to move either up or down. Okay. uh we have so many patterns now. If you take a look at this, for example, what pattern is this? It kind of looking like a W pattern. Isn't that is a pattern? Now take a look at this. Price went up, dropped, went up, dropped, went up, dropped. What pattern are we seeing now? You might not know, but this is a head and shoulder. Whereby this is a head, this happens to be the first shoulder, this happens to be the second shoulder. This is the head and shoulder. Okay, now let's go again. This is another pattern. Remember, I spotted two patterns right now. Now let's go. We have this, market dropped, did this, came here. What pattern is that? This is a bearish pennant, or some people call it bearish flag pattern. Have you seen? So there are so many patterns in the market. Okay, but with the help of the trend line, you can spot effectively a particular pattern that is forming the market. Because sometimes with the ordinary eye, if you're not trained, if you're not a professional, if you're not into this very well, you might not understand the pattern that price is forming. But with the help of with the help of this tool called a trend line, you can effectively spot out a pattern. Like, okay, let me spot this one out. I drew this down. I'm now trying to spot out this pattern. So it will be a lesson for another day, actually. To be a lesson for another day, because I'll teach you how to spot price patterns. So in order not to miss that very lesson when the time comes, subscribe to my channel. Okay, so whenever I upload a video, you will get it from your end. So I'm trying to spot this pattern now. Have you seen? I'm using with the help of this trend line tool. Have you seen that is at the end of, is now giving me the shape of what the market did at that very point. Have you seen? Now forget about these candles now. Now look with the lines you've drawn on your chart. What pattern is that? This is now the W pattern. So with the help of trend line tool, you can detect what pattern the price is forming. But if you're advanced already, with your eyes alone, you can spot the patterns that the market is forming. And that's the level I want you to get to. Okay. So price pattern is it kind of shapes the price, the candlesticks on your chart tends to form as they go up or down. Okay, there are so many price patterns, You can choose one or two or three of them and trade with them. It's okay by you, by that. Now, what is a trend line? Like I said, a trend line, that tool I was using to detect which pattern was forming. This is a trend line. We have this horizontal, we have this, the one you draw for yourself by yourself, and we have this vertical. Okay, So we have so many trend lines. These are the trend line. All these lines you're seeing, these are called trend lines. They are used to determine the market direction or to give you a clear picture of where the market is going or the pattern the market is forming. Now we have trading sessions. What is it? We have three basic trading sessions in the forex market. Okay, we have the London, we have the US, and we have the Asian session. Some of them call it the Tokyo session. Okay, now London session we trade this at from morning to afternoon. Then the evening, from evening, we trade the US session. Then at night, like this, the Tokyo or the Asian session have started. Okay, and these sessions, the London session and the US session, are the true main sessions that the big boys in the forex market usually use to trade. Because if you come now to the forex market at this time, market doesn't move very well. Okay, for you to make effective profit in the market, you must trade when the market is very active, like the London session or the US session, whereby price tends to travel to your direction or gives you profit faster. Where because we have fast moving candles at that point. Right now the market is so slow. Okay. Now we have swing highs and swing lows. Swing highs. What is a swing high? A swing high is the highest point the market went at the particular time. At the swing low is the market, the lowest point the market went at the particular time interval. Now, let me show you. We have this. This is a swing high candle. This is a swing low candle. This is a swing low candle. Okay. And swing high, low, low, high. Okay. Low. So these are swing low. The highest point the market travels to at that point is the swing high. The lowest point the market travels at that point is the swing low. Okay, don't worry, I'll speak deeply into this and you understand this at the end of the day. Now we have indicators. We have two types of indicator. We have the trend indicator, we have the oscillators. The trend indicators are the ones that have been inserted on your chart. For example, if you don't know how to navigate through your metaphor trader, please watch my first video. It's there how to navigate metaphor trader. It's there. I will include a link in my description right now. Now we have, look at the trend indicators here. Look at it. Okay, parabolic star, moving average, Ikematsu, envelopes, Bollinger Bands, and all that. Now let me insert one or two so you see what I mean. Let me insert a moving average, for example. Done. And then let me insert another one, Bollinger Band. Done. All right, let me go back. Have you seen? See the moving average now. This is a moving average and this is a Bollinger Band. The green lines are the Bollinger Band. The red one is the moving average. See? Have you seen? Most traders use them to detect price direction. Okay, but not me. I don't use this. Now let me go back and insert the oscillator. An oscillator. This, have you seen? Oscillators. Have you seen them? So many. So many. Okay, we have the volumes and we have the Bill Williams. This, I don't know people use them, but basically trader use either the trend oscillators, indicators, or the oscillators. Now let me insert some one or two indicators and show you. Let me insert the RSI. Have you seen? This one are always below your chart. They are basically meant to follow prices up and down. Anywhere price goes should be where they are going. Now, the trend indicators are lagging indicators. This one lag. The trend, these ones I used here. They are lagging indicators. All right, whereby they tend to only move when price have moved. They only move when price have moved. But these ones, oscillators, they move before the price move. Have you seen the difference? The trend indicators are lagging indicators, while the oscillators are leading indicators. What do I mean? I will repeat again. These guys, they move only when these candlesticks have moved, which are the prices. Now, but this guy, they move before this candlestick move. That's why we call them leading. We call this ones lagging. And you can't use this to determine immediate direction of the market, except for a long term. Only long term trader use this. But make use of these guys because they tend to go before the price. They are designed to predict before what the market will do. Okay, so This is the difference between trend and oscillators, trend indicator and oscillator. That's why I mentioned indicators and I had to break it down. So basically we have the moving average and they have the oscillators, but not just the moving average. Like I said, like you saw here, we have the Bollinger Band and so on. There are so many trend indicators that you may want to use to trade. All right, so this will be all for today. Please guys, if you find this video helpful, do well to subscribe to my channel. Okay, subscribe to my channel. uh Go to description below. You see links to my trading book, my book I wrote on Divergence. You see links to the recommended broker you should use, a very good one this year 2023. You will see link to my WhatsApp group. All right, so get all those links and then uh stay connected to our channel and then stay connected to our trading group. Also offer signals as well. So thank you very much guys for your time, and I wish you guys all the best.